specific purpose to having an industry session versus a technical session, right? So, over your 6 full day sessions that you had, I think you have 3-4 industry sessions and ITS, ITs and financial services that you clubbed together. And really the purpose is to give you a very practical perspective on some of the issues that are unique to this industry. So rather than getting into the general issues which you have had separate sessions on, whether it's comparability analysis or the application of the most appropriate method or risk adjustments, and I think you have a session later on domestic transfer pricing as well, or how to use databases. Some of these, most of these general issues, travel across industry. But what I want to achieve, and which is what the purpose of this session is, that and I have an experience in both of these industries. I focus more on the IT/ITS industry now than I focus on the FS industry. But obviously, being a large firm like ours, we have access to what's happening in that industry as well. So I'm going to use this 90-minute session to give you some really peculiar issues that are faced by taxpayers in these industries. So while we have these slides, you'll see me sort of going through these issues, not necessarily in the same structured manner in which these slides are, but I'm sure that when you look at the slides after this session, you'll relate to some of the stuff I've said. And we'll then quickly at the end walk through the slides to ensure that whatever points I intended to cover, I did cover as a part of the overall discussion. So let's, before I start in the IT/ITS industry, anybody who's got specific experience of handling clients in this industry, so that I know whom to ask questions during my conversation with you guys. So that's useful. So, let's look at the 2 types of business models we see in the IT/ITS industry today. And I'm saying from a transfer pricing perspective, what are the 2 types of business models which are relevant and which create their unique issues from a transfer pricing perspective. The first business model is an Indian IT company, and you can think of an Infosys, you can think of a Wipro, you can think of any of the companies that are set up from India. So the entrepreneur and the shareholders are all from India. India was set up, India has the delivery centers, or it was set up to deliver services from India. And then over a period of time, and of course you had to set up sales and marketing offices because your clients were not necessarily in India. Because the way this industry evolved, that most of the clients were from the developed countries because there were huge cost saving opportunities when you offshore to India. And so you started by leveraging on the technical manpower available in India and built sales and marketing capabilities wherever your clients are. And this would generally be to start with in US, because US is the largest market for Indian IT companies, or it used to be. And increasingly then you spread your market to Europe, especially the English-speaking part of Europe. And then as you matured, you even went to non-English speaking parts of Europe, and then when you had the necessary size, you even started talking to countries like Japan, China, South America, which are very peculiar countries, not necessarily only because of language, but also because of the very different way businesses are done there. So, different Indian IT companies are at different stage of business development. There are some, and we can take the top 3, the Wipro, Infosys, and TCS, who have probably now matured enough to reach everywhere. They would typically have a presence in the entire globe. They've even gone, most of them are there in Japan, most of them are even in very, very obscure countries like South America, not the large ones, even the small ones like Uruguay and all that. And increasingly, can you tell me which is one region in the world where even the most mature of Indian IT companies are still just establishing their presence? Africa, that's a good one. And when you think of Africa, think of Middle East and Africa as one country or one region. Because interestingly, you can see them on the globe, they are pretty much joined together. And that is the next frontier for the Indian IT companies. Not traditionally have Indian IT companies had large presence there, but increasingly Middle East is the gateway to Africa. in a sense, because the money flows from there, that has traditionally flown from Middle East and now increasingly from China. So you have a set of Indian IT companies who are as mature, who have a presence everywhere, and then you have the second tier and third tier who are more present in the more developed markets. Why am I making this point? Why is it relevant from a transfer pricing perspective? Three things happen and we are still talking about the Indian IT company as a business model. I'll come to the foreign IT companies who come to India. That's a separate business model, right? Let's stick to this for a moment. Why is it important for us to understand this? As an Indian IT company matures, it will mature in three broad directions. First, it will mature in the high-end nature of the work that it will be able to deliver to clients. So earlier it was very basic IT work. At some stage then it became manpower supply. So all you did was you took engineers from here and deputed them to the client side. They would work and you call in a crude way it was called body shopping. And then you mature to provide integrated solutions based not just on services but developing your own technology platforms and integrating your intellectual property with the services. Because the more you mature, the more value you can charge your clients. Right? That's the maturity in the kind of services you provide. The second maturity is in the way you sell to clients. Earlier, sales for these Indian IT companies was a fairly routine function because there was such a pull that clients, if they bought these services in the US, would probably pay 10 times of what they would pay if they were to buy these services from India. So selling was required, but as long as you had credibility, you had a lot of pull, customers used to come. So the sales function was, in the old days, you started with being a very routine function. It started being just exchanging information, data on what capabilities we have in India, and so on and so forth. And clients used to say, there is so much cost saving that the value proposition is very strong. And if you have a strong value proposition, you don't need to sell hard, right? And the value proposition in the old days, where you were only doing body shopping and low-end IT work, was very strong. So the capability of the sales organization, and sales always needs to be next to the customer. You need to have some sales support here, but the front-ending sales needs to be next to the customer. So the second maturity is that the sales capability has matured over the period of time as it has become more competitive. Not only there is more competition from India, but we also compete with Philippines of the world, and we also compete with East Europe, who have similar cost-saving opportunities, who have similar talent capabilities. So the sales organization, which is based overseas, needs to also then mature as more competition increases. And also because your services also grow, right? The technical or the complexity of your service grows. So the sales guy's ability to communicate the value that you can deliver needs to be there. Earlier, if you were doing only body shopping, the sales guy only needed to say, you need the engineers of this type, this is the cost in India. So the ability of sales to communicate the value proposition was basic. But today, you're not delivering those kind of services. You've moved on. You're delivering IT-based technology enabled and supported by a service. So the capability of the sales guy also needs to grow up. That's the second. The third thing, and which is the more recent thing, is clients are no longer happy if you deliver services only from offshore at a low cost. Because they've realized that as you grow in terms of your maturity as well as your complexity of services, a larger and larger proportion of your service needs to be delivered on-site. It could either be at the client location, which is how it used to be earlier. So client used to say, okay, you can have 80 people in India, but you know what, keep 20 people in my office because I need these 20 people to supervise the work of the 80 people or interact with the 80 people and bring everything together, and they need to be in my office. So the on-site concept, but the on-site concept has evolved. Now that 20, for example, in some jurisdictions where clients, like financial services, the 20 has become 40. So 40% of the people are becoming on-site. And more importantly, clients are also not happy if your offshore capabilities are only in India. Because from a disaster recovery or from a geographical risk perspective, they don't want that, if something happened to India, and the capability of India to deliver those services or lines are down, because there are only 2 or 3 lease lines that connect India to the rest of the world. If those lease lines are down for 2 days, and you're doing mission critical work from India for a financial institution whose entire website backbone is being run from India, then the bank would be out of business. So they're no longer comfortable that you have all your offshore capabilities only in India. So they are asking, the way the need is evolving, they want you to develop near-shore, offshore delivery. So just rather than just having a delivery capability in India, can you build an offshore delivery capability somewhere close to US, somewhere close to Europe? So are you able to appreciate the way I said three things? I said the complexity of the work is increasing, the sales capability is increasing, and the delivery models are changing. Fair? Now, now let's look at the transfer pricing impact of this. The transfer pricing issues for outbound IT companies is, let's call them outbound IT companies, is actually very straightforward. The challenge is, how do you implement it, how do you benchmark it, and so on and so forth. Because in the old days, when really all you had in the foreign jurisdiction was an on-site team and some delivery folks, and their work was routine, you could give them a cost plus and bring the rest of the profits to India. Fairly straightforward. That's what you would do, right? Okay, what do those guys do? Those guys are doing routine sales, those guys are doing routine delivery, all the hard work is happening here, all the technical capabilities are residing here, all the sales decisions are taken here because those guys are only communicating. So in the old days, you could simply give a cost plus to those people and the rest could come to India. Fairly straightforward transfer pricing model. As sales capabilities increase, can you give a cost plus to sales? Because the capability of the person, the strength of the sales organization is growing. Because their strength is growing, their capabilities are growing, you are incentivizing the employee by saying, if you do this much sale, I'll give you this much bonus. Can you give a cost plus to an entity like that? Or will you give them a percentage of sales, like a distributor? Right? So as sales capability grows, you have to change your cost plus model to a model which rewards them for the value they are adding, rather than just the routine function they're doing. And then the third piece, as delivery capabilities are getting more and more complex, even there, and they are taking more and more risk, and their delivery is not just routine. Some of the delivery is fairly independent of what you do, and they are also building delivery not necessarily only when they have work, but in anticipation of work. So they have some business risk there. Can the delivery be also routine, or do you need to then think of a different way of rewarding delivery? You need to think of a different way, right? It's not a cost plus delivery. So this is really the only, if you ask me, the transfer pricing issue with outbound IT. Then there are peripheral issues. One peripheral issue is, the contracts are signed by the overseas entity, but since clients see the Indian parent as the key person, they ask the Indian parent to give a performance guarantee, and then the transfer pricing issue is how much should you charge for that performance guarantee. This transfer pricing issue is not independent of the business model and the transfer pricing model you put in place. So this is the proposition I have for you. You have a client who comes to you and says, I've set up a foreign subsidiary, and the foreign subsidiary is going to contract with clients. Because normally when you set up a foreign subsidiary, the business reason is because clients are more comfortable contracting with a local entity rather than contracting with India. For various reasons. You could do it for visa reasons, because it's easier to get visas in a US legal entity. You could do it because the client wants to be able to sue a US entity rather than having to sue somebody in India. So the contract, so I'm a client, I come to you and say, contract is signed by the US entity. There is a sales capability there which helps us get the contract. We also support from India on the sales because they need various inputs on what is the pricing, what is the quality, and we need to showcase our delivery capabilities when we are doing the selling. So we also give inputs on that. Delivery, 30% of the delivery is going to happen from there, 70% of the delivery is going to happen from here. But as things mature, that 30% could become 40%, and that 70% could become 60%. And I want you to tell me that out of the 100 rupees that the foreign subsidiary bills to the client, how much should I pay to India? That's the transfer pricing question. What should be the price for the intercompany charge? Now, transfer pricing is common sense, right? So just think about this for a moment and tell me, what are some of the aspects you will consider when you're deciding? And I've given you that backdrop. You could have a cost plus for the various functions that the overseas subsidiary are doing only if those functions are routine in nature and not otherwise. You could have a return on sales for if the sales functions of the overseas entity are more than routine. So they are adding significantly more value than just the routine sales. And delivery is what kind of questions you will ask client to understand how you should deliver the revenue. What would be the questions you would ask me as a client, or what would be the direction you would give me broadly if I had to develop a transfer pricing model for this? Why don't you react since you had some experience in IT? And it doesn't matter if you have experience or not, but just common sense. How would you think of a transfer pricing model in this case?
If there's companies having other foreign subsidiaries, what exactly they are remunerating each other? Or if they're having the foreign subsidiary in the same region, probably before that, what is the exactly revenue sharing factor they are sharing?
RSF.
Or you can benchmark the search result of that region and then decide on the revenue sharing factor.
So you're in principle saying that, or agreeing with me that cost plus is not appropriate for the sales function, assuming you've done your functional analysis and validated that the role of the salespeople is not routine. Right? And what are some of the things you will ask the client to determine whether the role of the salespeople is routine or not?
What kind of, they will try to put it in this way, that what kind of work the assignment is. Say whether it is product driven, whether it is KPO type of work, it is type of a BPO, that means some kind of procedural kind of work which you are just able to execute as and when on routine basis, or this is kind of a value additional job. So what kind of functionalities those people are supposed to have
of the overseas subsidiary.
Overseas subsidiary. Now suppose some of the things delivery work, that whether that particular subsidiary people will be able to deliver the job fully from that particular, or they will need something from the backup from India.
Right.
So what is the functionality of people required, or what kind of backup is required from India? So total assignment, what it is made up of, and what will be the part of each of the person, and what is going to be the value addition from each of the areas.
You're moving in absolutely the right direction. But let's focus on sales first before we go to delivery, because sales and delivery are two distinct functions and both of them are extremely important. So I'll come to the delivery piece, but on the sales piece, what questions will you ask the client to decide whether the sales should be a cost plus function or should it be a return on sales function? And when you do return on sales, there are two ways to do return on sales. You can either give them an RSF, which is gross margin. RSF is nothing but a gross margin that out of the 100 you will keep 10 and give 90 to me. So your gross margin will be 10. So whether you call it revenue split, whether you call it gross margin, it's essentially the same thing. Or the third option is to give a net profit. So you say that I will not give you a gross margin, but after considering your sales cost, I will ensure that you earn a certain net margin as a percentage of sales, not your cost, but as a percentage of sales. So how will you decide which of the three options are more appropriate? Or not decide, what questions will you ask yourself or the client to understand and make that distinction?
The marketing, either the marketing is done by the subsidiary or who is getting the clients, because in the sales function the clients are involved. Am I getting the clients or the marketing people there?
So as a client, I'm telling you that I have a brand, I have a history of delivering excellence, and clients know me worldwide. Even they know me as an Indian headquartered IT company. So I would tell you that I'm getting it's because of me that the client is coming even to the subsidiary.
Then probably it would be like, say with the example which you gave, 100 rupees, say 10 you keep and 90 will be returned to me. After benchmarking the other US entity who do the same function of marketing.
So you will look for US distributors
yes.
of software services
yes.
and find out their gross margin.
Yes.
And whatever their gross margin is, you will decide that should be. But how will you benchmark or how will you identify what is the intensity of the selling function of the US distributors that you are finding in the database? Because, and the reason I'll translate that question into a functional analysis question, the higher the intensity of the sales function, the higher should be the gross or net margin. Right? You don't know what the right answer should be, but you're looking for that answer through the benchmarking analysis. That's the purpose of transfer pricing. How will you get that answer from the data that you get from the database?
Probably look for probably look for companies or comparables who are more engaged in marketing and advertising functions.
What is the financial information you look for? Because in the database you will not get this qualitative information, right?
Yeah, but we can still get, from Bloomberg we can still get the BD, the business description, and we can, there is like, they give that the company is either engaged in marketing, advertisement or for example like that.
I'm not sure, because companies will write their business description. I may say that I'm engaged in selling of software services, but how intensely and how much value I add in the selling, how many relationships I bring, you won't get that from the business description, right? Or even if you get it, that may be marketing literature, that may be written to entice potential clients. That's not sufficient for a transfer pricing economist, right?
They will see the percentage of sales and marketing to sales.
Yeah, that is a good direction. So what she's saying is, the more intense the marketing function, the more you will spend to market, or more efforts you will need. You will have higher wage employees, you will have attendance. See, and in this business you don't really advertise. In IT services you don't advertise and sell. Yes, you do advertise, but it's soft advertising, because this is not a B2C business, it's a B2B business. How do you advertise? Or how do you market? You participate in forums, you engage with clients through their community of CIOs and so on and so forth. You participate in conferences, business conferences. So there are a lot of things that you do to be able to sell an IT service. And one way, through the benchmarking analysis, is to see what is the amount of expenditure those comparable distributors are incurring as a percentage of their sales. And the higher the expenditure, a reasonable inference can be drawn that the higher is the intensity of the marketing function. You will know the sales expenditure as a percentage of sales of your client. He will tell you that generally, where we are spending 15% of sales in the US to generate this sales. Quite intense. It's very, very intense selling function. 15% of sales is a very high intensity selling function. So when you look for comparables, you will try to find comparables who have similar intensity of selling functions. And it's one way to measure that intensity is take their SG&A in their P&L and divide it by the revenue. If it's in that range, then you know that you have found distributors who have similar intensity of selling functions. Then you will also be able to find their gross margin or net margin, and that will become a clue for you as to how much should be the reward for the selling function done by the US subsidiary. And that can help you decide the RSF also, because gross margin is nothing but the revenue split factor. Are you with me so far? Yeah?
Yeah.
Okay, now let's look at delivery. So to your question, the way you gave the reaction, that delivery, and I agree absolutely with you. When you look at delivery function, you have to, in an IT company, ask 2 or 3 questions. One is, who develops the capabilities to deliver? Who trains the employees to be able to deliver? Who bears the risk of the bench? Because the biggest risk for an IT company is the bench, the utilization factor as you call it. An IT company, and if you read any annual report of any Indian IT company who shares this information in their IT report, they focus a lot, and it's one of the things that analysts track. What is your utilization percentage? In a bad year, the utilization percentage could fall as low to 60%, and in a good year it could go as high as 70-75%. It typically doesn't go beyond that, because you don't want utilization at the cost of training, because you need to continuously spend time training your employees as well. So you want them to be on the bench for some time so that they can train new areas. So the delivery, the 2-3 questions that one needs to ask to decide is the overseas, because your question that you would ask is the overseas subsidiary a routine delivery service entity, and is the delivery fundamentally being driven from India? That is the question you have to ask. The answer to that question will be depend upon who bears the bench risk, who trains, who develops the training methods and methodologies. Who develops the processes that will be implemented when the people sitting there in the US will actually do the delivery? Who will supervise the delivery that is happening at the client side? Will it be somebody sitting from India who will take the final call? And normally, at least that's my experience, on-site delivery is significantly integrated with delivery in India. It could change in the future. Business models may become so mature that the on-site delivery tomorrow may have nothing to do with offshore delivery. That day is not come, at least where we are in the today's economic environment, it seems that offshore delivery is still the driver. And not only is it the driver, but the risk of the bench, the risk of R&D, the investment in R&D, the investment in training are all being made in India rather than being made, because it's difficult to have a bench sitting in the US. It's a high cost bench. Then their business models will not work as efficiently and profitably. So if you get the answer to these questions, which leads to a conclusion that delivery is a fairly routine function, then can delivery be cost plus? But it will be a technical support cost plus. Technical support cost plus can be higher than a normal cost plus tech, because those people sitting there are still engineers. And you will have to find out the cost plus of similar companies in the US who have similar kind of people and employ technical manpower. And what is the margin they are earning on their manpower, technical manpower who provide their service. It may not be 20% because US is a high cost economy, because the cost base is high, so the markup will be on the lower side. But those are the kind of comparables you look for. So effectively, the answer you will reach is that the overseas IT companies' overall margin will be a blend of these two things. An appropriate percentage of sales on the delivery or on the sales, and an appropriate percentage of cost, delivery cost, because of the delivery functions. And this is how a transfer pricing model would be developed for an outbound IT company. Now so this is the theory. I would say this is the model I've discussed with you. What kind of issues have happened in India when tax authorities have reviewed these things? So the biggest issue that has happened is that tax authorities in India, still are to an extent staying in the mindset of 10 years ago. They still perceive that all sales and all delivery abroad is cost plus, and everything else should come to India. To an extent, if you are an SEZ in India, eligible for a tax holiday, that's what you would want. Because if you can get more profits to India, and if it is coming from an SEZ, then anyway that profit will be exempt. And you don't want to suffer a TP adjustment, because the moment you suffer a TP adjustment, you can't get an exemption. That's the law, right? So, but that doesn't mean that your transfer pricing is compliant from a US TP perspective. Because if you get more profits to India because you follow a cost plus there, or the tax authorities follow a cost plus there, US IRS is never going to accept it. They say that you are doing much more than a routine sales function. Why are you not giving a return on sales? Why are you giving a cost plus? So, what has happened and where we stand? There are around 4 issues that have been raised for these companies. First is tax authorities, and sometimes even taxpayers, want to treat everything done offshore as cost plus, which may or may not be consistent with how their functions have evolved abroad. It could have been a cost plus 10 years back, 5 years back. It could even be a cost plus today if that's what they actually do. But that is the question that a consultant should ask. That is the question a tax authority should ask. And if India doesn't ask, because you're getting more profits to India, be rest assured that US IRS will ask. So that is how we have to think about this piece. That's the first issue. The second issue is, interestingly, and for reasons not known to me, in the transfer pricing documentation that Indian IT outbound companies prepared, they used India as a tested party and said that I'm making more than enough money in India compared to an average of all the IT companies in India, and so whatever I'm leaving in the US must be an arm's length, whether it's a loss, whether it's a profit, whether it's a high profit and all that. Technically, I mean, which is the least complex entity in this equation? The subsidiary. So who should be the vested party? Yeah. So the other issue that has been debated is who should be the tested party. Interestingly, and I humbly disagree with that, there are Bombay Tribunal rulings which have also said that the Indian entity should be a tested party. There are 3 of them: Onward, Syscom, and there's another one which I don't know. But this is not how it will eventually get panned out, because if I asked you a simple question: who should be the tested party? And you said, of course, the subsidiary. In the old days, there could have been a reason for using India as a tested party if you didn't have qualitative data. Because there are 2 criteria for deciding a tested party. You had that session earlier, right? In one of your earlier sessions, how do you select a tested party? Least complex and reliable financial information is available. So these 2 criteria. And in the past, getting access to foreign databases and getting financial information of the subsidiaries, looking at this qualitative information, was not necessarily there. So in the past, you could have had a reasonable basis to say, this is the reason I'm not selecting a foreign as a tested party. But today, I think you can get access to these foreign databases and you can get access to this kind of financial information. In fact, there is an Ahmedabad ruling in the case of General Motors, which looked at these Bombay Tribunal rulings, which decided that India should be a tested party, and it looked at international literature. It looked at the UN India chapter to the UN Transfer Pricing Manual, and said that foreign company has to be a tested party, not Indian. So I agree more with the Ahmedabad Tribunal on this one than the Bombay Tribunal. The third issue is the Indian company gives guarantees to the foreign subsidiaries. These guarantees could be financial, and these guarantees could be performance. Performance guarantees are given to the clients on behalf of the contracting subsidiary. Financial guarantees, I think you have a session on that. How to talk about the arm's length benchmarking of financial guarantees. Or I'll cover that in the FS session. Because that's a pure financial instrument, which is fairly independent of industry. But performance guarantee is quite unique to this industry actually. And if in your transfer pricing model, which we first discussed, you conclude that the overseas subsidiary is getting a return on sales and is getting only a routine reward for delivery, the rest of the performance risk is anyway borne by India, because if tomorrow something goes wrong, the India will have the residual profit or loss. Then in that case, the right transfer pricing answer should be that you don't need to charge anything for the performance guarantee. But if your transfer pricing model is not correct, if you're leaving all the profits there for some reason, then you need to charge for the performance guarantee. So the only time you don't need to charge for performance guarantee is if you've characterized the Indian entity as an entrepreneur and bearing all the risks, and you have characterized the foreign subsidiary as a routine IT service provider and a distributor. No distributor bears performance risk, right? So if you go to a Vijay Sales and buy the Sony TV, who bears the performance risk? Who raises an invoice on you? So you pay Vijay Sales does a P2P sales with you, but does Vijay Sales bear the performance risk? No. Sony bears it. What does Vijay Sales get? It gets a commission on sales, nothing more. Applying the same analogy, if your transfer pricing model is that you're characterizing the overseas entity for right reasons as a distributor and an on-site service provider, then you don't need to charge him for a performance guarantee. It's fundamentally you, the client anyway was looking at you for the performance guarantee. It's just explicitly you've given it. So you should be able to demonstrate that. The fourth issue is really around, the struggle we are having on benchmarking, which is very fact specific. So Europe, for example, you don't get qualitative information on the intensity of the marketing function. Whereas in the US financial statements of publicly available financial statements of subsidiaries, you can get this information. In Europe. The manner in which they prepare financial statements or the manner in which those financial statements are summarized in the databases, you don't get this quality information. So you are at a loss a bit to make inferences and arrive at the right gross margin or the revenue sales factor. So the quality of financial information in the databases, especially in Europe, can be a challenge when you are comfortable about the answer you got for Europe. So really, these are the four issues. So I'll just summarize. For Indian outbound IT companies, demonstrate the nature of the selling function. If it is not routine, it is not cost plus. Second, delivery. Identify whether delivery is integrated with India and who bears the training R&D risk. And if India is bearing the training R&D risk, the delivery will be a fairly routine function. And performance guarantee would be subsumed in your TP model. If you have good quality data, take overseas subsidiary as a tested party because that is the right transfer pricing principle, and demonstrate that the profits of the overseas subsidiaries are arm's length and the rest is floating. Yep. Now let's go to the reverse model, which is actually interestingly, all that we discussed is not captured in the slide. So if you've been looking for this, you won't find it. I think I took the same session last year, and when I took that session last year, my experience was that Indian outbound IT companies are not an area of discussion at all, for some reason. So, and I prepared these slides last year, and I didn't know how much time to spend on outbound IT companies because when I had this conversation with the people who were present there, and they started talking about comparables, e-clerks, mercs, and I said, okay, so the audience here is more keen to understand what are the transfer pricing issues when foreigners come through, because hopefully those are your clients. And obviously, that's a better client to have. But when I was reflecting on it this morning, and I saw the developments that have happened in the tribunal space on Indian outbound IT companies, the 3 rulings that we've got, which suggest that India is a tested party, the General Motors ruling, which says otherwise. So even though this is a small client base or small set of taxpayers, I was asking myself, why don't they have issues in India? The reason they don't have issues in India is because traditionally, if they have treated the overseas entities as cost plus and brought all the profits to India, why would you have an issue? And anyway, you would bring all the profits to India if you are eligible for an SEZ. The reason some of the reasons these issues are arising, and it's a very, I think Umay is talking about domestic transfer pricing later. Now, if you use India as a tested party, and just stay with me for a moment, this is a little, not complicated, but just stay with me. If you use India as a tested party for an Indian outbound company, how will you benchmark? You will say that I am earning 40% cost plus, and my comparables are earning 25%, which is why I'm at arm's length. Correct? So you will be at arm's length when you earn more than your comparables. Now there is a section 80IA 10 which denies you tax holiday profits if you earn more than normal profits. Are you aware of that section? So nothing to do with TP right now, but 80IA 10 is a section that's been there in the statute book for years now. And it applies to all tax holiday undertakings, which says that if your tax holiday profits are more than ordinary, then the excess profits will be not eligible to tax holiday. And the government's thinking was that if you pump more profits into the tax holiday undertaking with the reason to claim more tax holiday, then we will deny you that extra. When domestic TP came in 2012, what they did was they linked 80IA 10 to arm's length. So they said that, how do you determine ordinary profits? Ordinary profits is arm's length profit. And your TP study on one side is saying that my comparables are cost plus 15 and I'm making cost plus 30, so I'm at arm's length. So your TP study is accepting that you are making more than ordinary profits. Your TPO, not your TPO, the AO can take that TP study and say, "Arey, you are yourself saying you have more than ordinary profits, so as per 80IA 10, you are not eligible to the tax holiday." Do you see the irony? One way to address that is to actually do the right tested party. Because if the overseas entity is a tested party and it's earning the right level of profit, then this issue doesn't arise. So, and this issue has been raised for a couple of taxpayers. I think there are 4 or 5 tribunal rulings on this issue, where the Indian entity was earning more than the comparables. So while there were no TP adjustments, the AO decided to deny the tax holiday. Fortunately, the tribunals in those cases have said that just because my TP study says I have more than ordinary profits doesn't mean you can deny tax holiday. But those tribunal rulings were before domestic TP came. Before 80IA 10 was linked to arm's length. You can still use the ratio of those tribunal rulings, but it's a little more challenging. The tax officer can still say that those tribunal rulings are in an era when ordinary profits was not defined at arm's length, as being at arm's length profits. So just an interesting, and you should pick Amay's brain on this when he comes next.
Just a question on that. What in case if we use an internal TNM? Then would the ATI funda apply?
I don't know, I think internal TNM would still be technically wrong.
For proving myself at arm's length, why it should be wrong? It is currently
For an outbound IT company,
yeah, for an outbound.
just ask yourself, internal TNM means what?
I have an AE in US. Suppose I'm providing my services to them and as well as to other companies in US.
Can you compare two businesses of one entrepreneur, which are completely done in different ways?
In internal TNM, yes, why not?
So you are saying, so suppose you had 5 high-paying clients and 4 low-paying clients in the US market. And for those low-paying clients, you were doing directly business from India. And for those 5 high-paying clients, you had a subsidiary through which you do business. So the extra profit that you earn from those 5 high-paying clients, you leave it in the US subsidiary and give it much more than what it should deserve for the sales function. And let's keep it simple, the US subsidiary is only doing sales, nothing else, right? So for the 5 high-paying clients, you ensure that the profit that you report in the Indian entity is equivalent to the profit that you earn from your low-paying clients, and you use internal TNM. The flaw is, before you apply internal TNM, you first have to ask who should be the tested party.
Correct. My point is that I've used foreign as a tested party, but the TPO doesn't accept it. He uses internal TNM where I'm at ALP, and therefore I was asking.
You will take the advantage of the TPO's ignorance. But that doesn't make it right.
No, my question was that only. If the TPO is taking the internal TNM, and then, suppose my entity isn't.
Then you are safe from an ATI 10%. But that doesn't make it right.
My question was on the perspective of the
Appreciate. Now I understand the question. The TPO itself doesn't want to do foreign as a tested party. Fair enough. So now let's come to the other side, which is the more famous side of IT/ITES industry, because there are, I think, I've lost count, and I think I've stopped reading also, the number of IT/ITES rulings that come every week on small issues like turnover filter and size, the nature of business, KPO versus BPO. So what I've done in this slide is I've bucketed all the issues. That there are these 6 to 8 issues that can arise on comparability, and there are, I think you should read, like for example, I was shocked to see this. There is a Bangalore tribunal hearing that happened very recently, where the issue involved was turnover filter. As to, you understand, Jigar is taking a session on comparability later, is it? So one of the filters you apply to decide comparability is turnover. Can a 100 crore company be compared to a 4,000 crore company? And there are a lot of tribunal decisions on this. In that ruling, in that hearing, it seems there were 74 decisions that were placed before the tribunal members on what tribunals have said on application of turnover filter. And I said, wow, I mean, we can create issues out of non-issues actually. And this is the best example of that. So you'll hear more on this from me as we speak. Which is why I call it is a favorite area for transfer pricing assessments in India. But as a transfer pricing professional, it's the least exciting area for litigation at any level. Because what is the business model? The business model is that a foreign company has a market outside India. It could be an FMCG company, it could be an IT company itself, it could be a pharma company. Its market is outside India. One of its back office functions generally, it could be a customer interaction function, but one of its back office functions, and HR, legal, IT, research, R&D, one of its back office functions, they decide to set up a captive center in India to provide that service, a function, to all its business units worldwide. So the units would be spread all over the world, and they've outsourced some of their back office functions. R&D is not necessarily back office, but they would outsource the back office part of R&D to India, and India would provide that service captively to the clients on a cost plus basis. That's generally the business model. And there is a reason for this business model. The reason for this business model was the nature of work that is outsourced, the level of supervision and guidance that the Indian entity is subjected to from the foreign parents entities, and the level of risk that the Indian entity bears, because all methodologies, processes, know-how is provided by the foreign entity. And because it is captive, the Indian entity doesn't even bear a risk of building capacity. Because the foreign entity decides that, I think maybe I don't need 400 people in India today, but 5 years later I will need 400 people, but let me develop capability for 400 people. That decision and risk is actually taken by the foreign entity because it provides the capital for putting up that 400 seater. So given that all the risks and key functions are done by the foreign entity, even as a businessman, I would have said, okay, I don't have so much control. If you ask me to set up a foreign captive center, you give me a good return on my costs. I'll incur costs as you need them, and you give me a good return on the cost. Can you think of any other business where such a business model exists between unrelated parties? So normally we see this between related parties only, but can you think of a business where a cost plus model exists between unrelated parties?
Somebody is having access manpower or something, they may have some kind of, they are doing for themselves, but they are ready to do for somebody else.
So providing manpower. But that's an ongoing, that's a transactional service. I mean, a cost plus, you set up a facility, you provide a service, and that facility is used captively for someone, and that someone gives you a cost plus on all your costs. Can you think of?
There are large construction companies where they are not able to estimate the cost. They do everything on cost plus. They Jamnagar refinery or Reliance, build everybody on cost plus.
Whether in research, pharmaceutical research companies, something in research, can it be done?
Normally I've seen it based on FT, because the overseas company wants the pharmaceutical research company to take some risk of training the manpower. And they say that you hire people, will give you a certain amount per person. So it is not denominated at cost plus, but the closest industry is actually API manufacturing. You've heard of API conversion to formulations?
Yes.
So the medicine that you get in the tablet, in most cases is a very generic API that is converted into a capsule, packaged, putting the brand of the principal and shipping it out.
Companies like Dr. Reddy.
So they have a division like that. So a lot of Dr. Reddy's has evolved now, but there are a lot of small time companies whose only business is they'll have a manufacturing capability. They will convert the API into formulations, the processes, methodology, everything will be given by the overseas or Indian principal. And this guy will set up a plant. He will negotiate a cost plus. That iska jo bhi variable cost hai and the recovery of the fixed cost over a period of time. And whatever utilization I have for you, I will charge you a cost plus. In fact, the government also has a ceiling of the cost plus this guy can charge. It's there in the pharmaceutical regulations.
So is it like a Divi's laboratory you are talking about?
So I won't be able to give you names because most of these are private companies. Most listed companies have moved up the value chain. They become more risk driven and they do some of their own formulations because they have their own brands also. So these guys don't have brands. They're only providing this as a service on a cost plus basis. And in fact, a cost auditor actually reviews their cost. Before the principal signs off on the cost plus, he has to be comfortable that ye apne cost in karke hai na, or are you loading costs? So you actually have a cost auditor who goes in and checks the costs. So it's not unusual to see a cost plus business model even between unrelated parties. That's the point I was trying to make. Because sometimes some people say, if this happens only between related parties. It's not true. It happens also between unrelated parties. So the key issue here is what should be the markup on the cost. There could be issues around what should be the cost base, and generally the principle is you will take all operating costs, and there is a definition of operating costs. Are you familiar with the safe harbor regulations? Yeah, there is a definition of operating cost in the safe harbor regulations which is there in your subsequent slides. So the principle is that whatever operating costs are there of this captive cost plus entity, you will give a markup on that. Now, we obviously have a huge industry in India which operates in this way, and which is why you have a lot of transfer pricing adjustments in this area. But what are the key issues that arise? Yeah. So these are the 6-7 issues that these captive cost plus entities face when they are getting assessed. One is the rules say that you should use single, because you have to demonstrate that that cost plus they are charging is comparable to the cost plus that comparables are earning. And to demonstrate that, you will do a benchmarking analysis, which I think Jigar is going to walk you through the steps of the benchmarking analysis in a session later today. And you have to then do you have to apply various criteria to select those comparables and reject comparables. And that whole process is subjected to a lot of litigation. So what are the issues that arise? First issue is the rules suggest that you can use multiple year data only if you can demonstrate that the data, multiple year data has had an effect on your pricing. You know, if you look at the OECD regulations, then generally OECD regulations allow the use of multiple year data because multiple year data can remove trends or aberrations or can remove aberrations of a single year data set. So generally the global standard is to use multiple year data and normally it is 3 years. Some countries even allow 5 years. But India, because of the way the rules are written, have the tax authorities and even the tribunals have said that you can generally use only single year data because the manner in which the proviso is written suggests that you can use multiple year data only when you can demonstrate the impact on pricing. Is very difficult to demonstrate that because the reason you are using multiple year data is one, because of impossibility of performance. When you do your TP documentation in June, July, August, after the financial year has ended, and the single year data will be for that financial year which has just ended, that data will not be there already in the database. You will, when you search the database, you will get data of the prior 2 financial years only. So the TPO, when he does the assessment after 2 years, he does a refresh and takes data only of that. So there is, apart from principles of economics which says that use wider data to even out the aberrations, there is also an impossibility of performance issue. Fortunately, this issue is getting addressed because last budget, they said that they will allow use of multiple year data. And you won't, you'll be surprised if I tell you that just this change, and there's another change that they are making, will reduce more than 60 to 70% of the litigation we have on IT/ITS markups. Because the moment you allow me to use multiple year data and I know what data is there at the time when I do the TP study, rather than the TPO refreshing the search and then removing tweaks here and there, I have a lot of comfort and robustness in my TP study. Because if I don't know what he's going to replace it with, I'll always be litigating. So this issue is getting addressed or got addressed in principle in the budget where they said they will allow use of multiple year data, but the rules have not come out yet. So once that rule comes out, then the law itself will change, and that's been one of the biggest demands we made from the finance ministry, that you should allow use of multiple year data. And I remember when we had made this representation in the finance ministry, there was a statistic that NASSCOM has provided that if you took 3 assessment years, which were adjusted by the TPO, and you just allowed use of multiple year data and you allowed use of interquartile range, most of the TP adjustments will be gone. Because most clients were between 12 and 17. TPOs wanted it to be between 25 and 35. And because they were using single year data 1 and they were using only arithmetic mean with plus minus 5. So 17 just fell out of 25. Because plus minus 5 of 25 will be somewhere 18 or 19. So we demonstrated that if you allow multiple year data, which removes aberrations, which improves the quality of data, and if you allow interquartile range, any client who is between 14 and 17 will not have a TP adjustment. So only people who are a little below that, which is actually a very few number of clients or a number of taxpayers, you will get rid of all of this TP litigation. So that's been heard, and I think the complexity of transfer pricing litigation even for this industry will fundamentally change once you get rid of these mathematical issues. The issues that will remain, secret comparables again goes along with use of single year data, because when the DPO doesn't find enough information on a single year basis, he writes to taxpayers or clients individually and gets that data. I have no issues with that, as long as he provides that information to the taxpayer in advance and gives an opportunity to the taxpayer to rebut it. In principle, while OECD also says you should not advocate it, a lot of countries use this secret comparables. As long as they give it to the taxpayer to rebut, I think it's reasonable. But I see this issue going away once you start using multiple data and there are enough data points, then the need to go outside the data set will reduce because you will have a good variety of data points, larger number of data points. The need arose in the past because when you use single data and you have only 3 data points, then you need to find more. The TPUs were compelled to find more. Now, the issues from 3 to 5 are all qualitative issues which are very fact specific. So for example, you gave an example of, let's say, I'm an IT service company and the comparable is a software developer. You fundamentally can't compare a software development company with a routine IT service company. Those kind of issues. So even in the ITS space, there are companies at the low end which do only voice. The range of margins and rates and for a voice BPO are very low compared to a software developer. Or a company which is a product company, you make that point earlier. Am I a product company which is using their product to deliver services? Rather than a pure software service company which is using manpower to provide services. Even those are different. So your industry analysis, when you write that up, when your understanding of the industry should demonstrate that in the IT space, there are IT companies of different types and you should compare like to like. Whereas in the past, what TPOs have done is they have tried to compare the high-end IT companies to a low-end IT company. And that issue will remain. That issue is not going to go away. Because even if you have multiple data, even if you have interquartile range, to ensure that the right kind of comparables are compared will still continue to be critical. The risk adjustment issue, the 6th and 7th issue is pass-through costs, which is basically some clients argue that, some taxpayers argue that, I have not used this floor space. It was underutilized. So why should I earn a markup on it? It sounds quite logical. Okay. अभी इसको सर्विस प्रोवाइड करने के लिए यूज नहीं किया थर्ड फ्लोर, सिर्फ फर्स्ट और सेकंड फ्लोर यूज किया तो no services have been provided, so can I recover it at cost? And those kind of arguments go. But fundamentally, those arguments are not entirely strong because even other IT comparables have that kind of risk. They don't necessarily have 100% utilization. And when you do their OP by TC calculation, when you do their margin calculation, you take all the costs. You take the entire rent cost. You don't have data to exclude what portion of rent was underutilized. So when for them you're taking 100% of your rent cost, an apple-to-apple comparison requires you to do the similar thing for yourself. So, but those kind of issues have arisen in the past. I think the only time you can make this exception is when you're in a setup phase. When you're setting up operations and you have certain initial costs, which are one-time, then I think you have a case to argue that those costs should not be recovered with a markup. Because the foreign entity has decided to set up a center in India. And the initial cost that it incurs, and it could be underutilization, it could be some training or process transition, that is not for providing a service. And that can be recovered at cost. But on an ongoing basis, trying to take out some cost and saying that it's underutilization and I should not earn a markup on that seems a bit aggressive. And the risk adjustment issue is again a fundamental issue denied by tribunals. In most cases where you try to say that I'm a captive service provider, I don't have any business risk, I don't have to go and get customers. Whereas the comparables that you take, most of whom are listed, if they're not listed, they are large companies, they have a lot of business risk and you can make that out from their fluctuation in margins. So, riskier the business, the more margin a business wants. I am not a risk-bearing business, so I should get less margin. A very strong argument fundamentally and applying principles of economics. The challenge we've had, and we hope to eventually win on this, the challenge we've had is that tribunals have not been able to appreciate the methods that one uses to remove the risk element. So if your comparables are risk-bearing and are earning 30% margin or 25% margin, what econometric method should you apply to remove the portion of that 25 which is the reward for the risk they take? So there are statistical models to do that, but tribunals have said that those are very subjective. So in principle, they said that unless you come up with something very, very concrete, we are not going to give you this, you're not being able to demonstrate concretely how you're going to remove that risk element. But in principle, it's a very strong point to make because it's like this, if you're investing money in FD, you will expect a lower return, whereas if you're investing money in the fixed deposits of a company, you will expect a higher return because there is higher risk there. And in a financial instrument, you can easily identify the portion attributable to the risk. Can you apply, some of you who have studied in FM the beta models, can you apply the beta models, the CAPM model to be specific, or the sharp ratios, to remove the risk reward in the margins of those IT companies which are using as comparables? You can do that in principle, it's just that tribunals have never accepted it. What are the likely issues that are going to come up in the future? So let me. This is a big issue which needs to still be addressed, which is on BPO versus KPO comparables. It goes back to the same point that you should not take high-end companies as comparable to low-end companies, and the manner in which the special bench, and you should read this ruling, is that the way they've addressed it is a very reasonable way. They've said that, and there is a clue for that for the other sectors as well. So in the ITS industry, there is a definition of ITS in the CBDT rules for the purpose of section 10. That definition is very wide. It starts from low end and goes to high end. What the taxpayer was trying to do, and even the tax authority was trying to do to some extent, was to say that remove all high-end ITS companies, and if I am low-end, compare me only to low-end. Now, the tax authorities were using that to their advantage by saying, no, you are low-end, so I'll remove all low-end companies and compare you only to high-end. Whereas the taxpayer was saying, I am low-end, so remove all high-end companies, the classic debate. What the tribunal has done, which is a very sensible thing, they have said that it is very difficult to segregate low-end from high-end in such a clinical way, because ITS is a broad category of service. So we are not going to create, as a judicial interpretation, subcategories in ITS. So the classical subcategory was BPO, KPO, and you find this subcategory even in the safe harbor rules. And in fact, the taxpayer relied on that safe harbor rules to create those categories. But the tribunal said that it's very difficult to create such characterization, because over a period of time you will also move in terms of the quality and the complexity of work you do. So a BPO may have 10% high end, it may become 40% high end tomorrow. So rather than that, they said that the better way to do this is to find out the proportion of high end work you do. If it is very less, then don't compare yourself with comparables who are significantly doing high end work. Because even in low end IT comparables, there will be some high end. But if that comparable is apparently doing only high end work, and you are doing substantially less high end work, then you remove those kind of comparables, but don't create these artificial segregation, which is, I think, a fairer principle to apply in practice. And now that is a special bench decision, it's the rule of law as far as we are concerned, and unless it's get reversed by the High Court. But I think going forward, this is the much appropriate way that you do. When you do a functional analysis, you bring out what is the, if you do any high-end work, and what is the proportion of that high-end work. So when you're rejecting high-end comparables, you're rejecting them on the basis that these comparables are predominantly engaged in high-end work, and accordingly not comparable to me since I'm predominantly engaged in low-end work. That is the principle coming out of the Merz decision. The reason I wanted to use the safe harbor rules is to actually give you my perspective on how transfer pricing for captive IT/ITS is going to evolve in the future. Today, the debate has been whether you should be at 12%, 15%, 20%, 25%, and then the safe harbor rules came, because the reaction to the government was that this debate can go on forever. We can keep on arguing about whether a comparable is comparable or not, whether single A data should be used or multiple A data should be used. And there is so much qualitative input that goes into that, and in a TP assessment kind of a setup, you will always have debate, and this will always go to the tribunal, which is why we have more than 500 rulings on IT/ITS across all tribunals. So the feedback to the government was just come out with a baseline, that if you do this category of work and you return this much, no litigation will happen. So this was the intent of the safe harbor regulations, superb intent. Compared to the rest of the world, India's safe harbor is the most wide. Other countries have safe harbors, but they apply to very small categories of taxpayers. The problem with the safe harbor is the rates are too high. But I hope to see that changing. So for example, a lot of taxpayers say that at 20%, taxpayers' feedback is that 17.5 is a better and more acceptable number. And if the government were to offer that kind of a number, or 18% as a number, then we will simply go for it, offer 18%, rather than go through all these debates. So my hope for the future for the captive IT/ITES industries, and we also have the APA program now, where you can negotiate a markup upfront. My sense is that 80% of the clients will either go for the APS or the safe harbors. Because if you have to not do that, and if you have to take an aggressive markup, and you have to go all the way to the tribunal, because fundamentally comparability analysis is subjective, and the tax officers have a target and TP hearings happen in a constrained way, then the reward for going through the litigation is not good enough. You are at cost plus 12, you may get a cost plus 14% ruling in the tribunal eventually. Because people are thinking कि cost plus 15 में अगर नहीं होगा कुछ litigation या cost plus 16 में नहीं होगा litigation, then what is the trade-off that we are talking about? So my hope for this set of industry is that a lot of these issues can go away in the future if the safe harbors are set at the right number and the APA program works well. And a very few category of taxpayers will still have good reason to litigate and continue with markups which don't fall within the safe harbor or the APA regime. So, and if that happens, then, and if that happens in 2 years, we may not have a session for IT/ITES industry, at least the captive.
Sir, 50% is it an acceptable range to move from the IT and IT?
15%?
No, 20 is.
No, 20% is too high.
But then PPA is taking time, so what is the status in the interim period?
I think this year's TP assessments, if you were at, I think there are TPOs who have concluded TP assessments for ITS at even 20 or 22%. So if you were at 16, 17%, no, okay, 16 fell outside, 17, 18%, you would not have had a TP adjustment only in the, I don't know whether anybody else has had that experience, but with some TPOs, ITS was at around 20, 21, 22, 22 to be more specific, and 17, 18 was actually within the arm's length. So we are also seeing that litigation reduce even at the TP assessment, because what TPOs are saying is that if safe harbor is 20, which is safe, then it is above arm's length, because you can get a safe harbor without going through the detailed analysis. Then the arm's length should be slightly lower than that. So the thinking is that we can keep on debating about comparables and all these technical issues, but if you are somewhere between 16 and 20, eventually you should not have too much litigation. Anything below 15, if even if your low end is headed for litigation, for sure. But if you're really low end and you're at 15, 16, or if you're slightly high end and you're closer to 20, then if the TP assessment progresses properly, he's not too subjective and he's being more reasonable, then I think you could even have a clean TP order at 17, 18%. So the challenge I'm finding is that this is not being done consistently by TPOs. So some TPOs are still going as high as 24, 25, and in which 18 also doesn't fit in. And now AY 11, 12, the plus minus was 5. AY 13, 14, the plus minus will be 3. But what I'm hoping is that if they set the safe harbors correctly, and if the APA, once the first set of APAs come out, everybody will have a sense of what is the range of markups they are willing to accept. And then most clients or most taxpayers will ask themselves, let me fall within this, because nobody wants litigation. So let me fall within this, and if I can safely stay out of litigation if I fall within this, and let's say that range is 16 to 20. You have to ask yourself, what is the delta of tax, whether you are at 16 or 18. Sometimes the delta of tax is not too much compared to the pain you would go through if you were to get litigated. So that is, I think people are waiting for that clue, and once that clue comes, I'm hoping that this kind of litigation will go away. Financial services is actually not one industry, it's more than 4 or 5 industries. So let me give you a flavor of why transfer pricing is slightly different for financial services industry. So financial services industry is actually not about comparables as much as about understanding the business model. Because eventually in a lot of other industries it comes down to comparables, but in the financial services industry it's very unique, right? It's about capital and it's about manpower. So the people who are driving the decision of allocating capital and the people who have capital. These are the two factors of production in the financial services industry, right? Everything else is peripheral. And given that capital is so mobile and manpower is so intangible, you can imagine how difficult it gets to demonstrate what is the arm's length price for some of the things. Let's take the example, an easy example of broking. Everybody says that brokers are providing commodity services. When I say commodity means, what do? They help you trade on the stock exchange of which they are a member. And they charge you a percentage of the trade value for doing that facilitation. Of course, they have some capital risk because they have some margin money that they have to keep with the stock exchange. But normally, it's a service. Broking is a service. Broking is a service to trade on the stock exchange because he has membership and he has margin money and so on and so forth. And he's done some KYC to help you come on board because the stock exchange can't do that. Now, at one level, and this example is I'm using this example to highlight how different the financial services industry is. At one level, you can simply say, what is the broking rate? So what is the business model here which attracts TP? You will have a subsidiary of a foreign financial institution who is a broker, and that broker provides broking services to third parties as well as to related parties. The third parties would be anyone. Mostly it will be institutional investors, corporates. We won't typically be dealing with these foreign brokers' subsidiaries in India. We would be dealing with the Motilal Oswal or Anand Gandhi. But these guys would deal with the UTI of the world. These guys will be dealing with the Reliances of the world, the Birlas of the world. So they will have third-party institutional investors and corporate investors, and at the same time they will be also doing trades for their global institutional investors. And those guys will be trading through their FIIs. So the FI will be a related party of the broker, and the FI will place trades on this broker, which will be a part of the group. So the transaction you have to compare is, what is the broking fee I have charged my FII client who is a related party versus the broking fee I have charged my unrelated party who is an institutional client. Just common sense. How would you go about doing this comparison? Can you simply compare the rates? What rate am I charging? 25 basis points or 20 basis points for every 100 rupees that is traded. Because brokers represent their fee as a bips. The way they communicate their fee to you is as a bips. So the classical debate in broking is, what should be the basis points that you have charged to unrelated parties versus the basis points that you have charged to related parties. Now, of course, it goes without saying that the basis fee that you will charge to each client, especially if it's an institutional relationship, will be a function of what? The size of the relationship, the likelihood that this relationship will give you continued business. When I say size of the relationship, I mean the volume. And sometimes you will not go by volume, you will go by reputation also. That I want to do business with Reliance. I want to be their preferred broker. So I want to give them the best rate possible. So volume, which clients you want to work with, the size, the potential of that relationship to grow over a period of time, because it may not be good today, it may not be a big relationship today, but it has a potential of being a very big relationship tomorrow. The effort that you have to put to service that client, if it's a long-term relationship, and most brokers have institutional relationships which are long-term, you have to put in a lot of effort to service that client, because broking is not only about doing the trade, it is about what else do brokers do for their institutional clients.
So they do have some research arm with them.
Absolutely, research. What else? Very valuable service they provide to institutional clients, apart from research.
You have to have a dedicated team for.
So maybe what you are heading to is, they need to create access to the industry. So all brokers will have events where they will bring their clients and they'll bring a perspective from, because what do clients want? Clients want to decide which stocks to invest in. How do they decide that? They decide based on research. They also decide based on understanding a particular company, how it is doing, what are its business plans, insights from that. They want to also engage with regulators, because regulations have an impact on the industry, how will some industries grow. So a lot of these conferences get organized, a lot of these one-on-one discussions get organized, a lot of these interactions are facilitated by brokers. So that's also a service brokers provide to the institutional clients, that I will get you access to the best insights, whether it is through research or otherwise. Because brokers will have dedicated people following dedicated stocks. They will track that stock. Every guy will have 6-7 stocks he will track, and he will spend his entire year talking to all people in publicly available information, talking to other peers and getting that point of view. Why should you invest in this stock? So people go to brokers also because some brokers have better insights than other brokers, not just because of the platform they provide. So that's what I meant by service. Now, can you then, if these are the variables, can you compare one brokerage rate charged to another brokerage rate? Fundamentally. Because some of these variables you can't even do adjustments for, right? Because today so let's take an example of a variable, volume. I have a certain volume with an unrelated party because of which I charge a certain rate. Let's say LIC, I have a certain volume. It's not very high, so I charge a higher rate because it's not giving me great volume. They go to everybody. I'm not able to build an exclusive relationship with them. So when they come to me, I'll make the best of it. I'll charge a higher rate. Whereas an FII, who's my related party, he gives me significantly higher volumes. He's my long-term customer. He gets me a regular business. I have to spend more effort servicing him and so on and so forth. So I give him a lower rate. Can you compare the rate you charge to LIC vis-a-vis a rate you charge to your foreign FI or related party? I'll take another example. Let's say apart from LIC, you also have an unrelated FI sitting outside who does trade with you, and a related FI sitting outside who does trade with you. They come from the same market. Both are from US. I charge this FI from the US this rate, and I charge this FI from the US with the related party this rate. Can you compare both of them also?
No, it will depend upon the type of service.
Absolutely. So the debate that's happened in the till the tribunal stage is whether you should apply CUP, which is comparing the brokerage rate, or whether you should do internal T&M. What is the profitability of your business with unrelated parties versus the profitability of your business? You spoke about internal T&M. What is the profitability with related parties? Or even you could do external T&M. Because the profitability of the business with unrelated parties may be different from the profitability of the business with related parties for good reasons. So, do you broadly agree that CUP is not the right method? Or if you want to apply CUP, you need to figure out a way to make all those adjustments. Bring them to the same level by making the qualitative adjustments as to the differences in services that you're providing, the volumes you're charging. See, volumes, there are ways to do adjustments by using regression analysis. So if you go back to your econometric books, regression analysis tries to remove the impact of volume on price. So there is a way to actually convert volume, the impact of volume on a price, and remove it and make it comparable strictly. But volume is not the only difference, right? We discussed that. There are other differences. So the point I'm making here is that the ability to apply CUP will be a function of the ability to make these kind of qualitative adjustments, which is extremely difficult. So a more straightforward method to apply is because at the end of the day, I want to make money. Whether I deal with my related party or unrelated party, after considering all the costs I incur to service them, I want to make money. And if I'm making the right amount of money, then I must be charging the right brokerage rate. In fact, when I was speaking to someone in the industry and asked them, "ये तुम लोग brokerage rate कैसे fix करते हो?" तो बोलते हैं कि नहीं, brokerage rate fix नहीं करते हम लोग धंधा fix करते हैं कि कितना हम लोग को ये client से earn करना है. If I think he is going to give me $5 million of volume, I convert that into I should get $1 million, 100,000, 200,000 from it. So I try to and then convert that 200,000 into a brokerage rate. If he's going to give me $10 million of volume and my effort is going to mean that I need to earn 200,000 only, then I'll convert that into that brokerage rate. So they don't even, except for retail customers, they don't even have a rate card. That an institutional broker comes, I'll give you a rate card 0.5, 0.6, 0.7. Only retail brokers we have a rate card. ICICI Direct has a rate card. They have 5 rates. But that's not how institutional business works. And in this industry, from a transfer perspective, you'll only be dealing with institutional plans. So this is how financial services is very unique. Let me give you another example, and I'll take 5 more minutes. Let me use the right slide. Let's take the example of investment banking, which is another esoteric part of the financial services industry. What is investment banking? Investment banking is raising funds for a client. You can raise funds through different ways, or you help a client in doing mergers and acquisitions. So a client wants to do an IPO, you help him do that, and he wants to raise debt as an investment banker, you help him do that, or if he wants to evaluate merger with someone, you help him do that. And investment bankers typically earn a fee from the client, and typically that fee could be a combination of a fixed fee or a percentage of funds raised. So in a merger, it could be a combination, it could be a percentage of the deal value. And I do everything that is required to do a merger. In funds raising, I could charge a percentage of the fee. And the 4 key functions that an investment banking company does as a group, and with all of these 4 functions may be in different entities, which is where transfer pricing comes in, right? So the fee that you earn from the client, how should it be split between these 4 functions? Do you see the second box? Origination, structuring, execution, and distribution. These are the 4 functions that an investment banker does. Origination means originating the deal, who owns the client relationship and manages getting the job. Execution means that once you get the job, which is the team which will execute the deal, which will the team which will do all the work that they'll help you to go to the IPO. Huge amount of work that the investment bank needs to do to take you to the IPO. IPO documents, structuring, liaising with legal advisors, other bankers, if there are co-bankers, liaising with tax advisors to get clearances. That's what the investment bank will do. Structuring means the actual structure of the deal. If they're actually taking some positions underwriting, then what is the underwriting fee they will charge? What is the risk they will be willing to take as a bank? How much capital will the bank itself put? Because investment bankers not only provide services, they also give you capital cushion. So if you're going for an IPO, they will also say that we will be underwriters, in which case the bank is putting its own capital at risk. And then the distribution, which is they will create a market for your securities. If it's a debt security, they will create a market with institutional clients. If it's an IPO, they will create a market with brokers who will then market that further to shareholder, potential investors like you and me. All of these functions are fairly non-routine functions and integrated functions. Each can't survive without the other, and none of these are routine, straightforward functions which can be remunerated on a cost-plus basis. Client relationship is important. The execution of the deal is very important. Getting the market for buying the securities or the IPO or the debt is very important. And even structuring of the deal is extremely critical, especially how much capital you put at risk, because that decides your eventual profitability on the deal. So the premise in investment banking is that, and without focusing on the slide for a moment, is that what is the transfer pricing model which will give the best allocation of the client fee amongst these various functions? Can it be cup? Never. You will not have a situation where 4 different unrelated parties are coming together and doing this and splitting the fee. So the way it would happen, and which is unique to this industry, is that you will split the fee, or you will split the profit from the deal to the bank, and you will split it among these functions in a certain ratio, and that ratio should represent what is the contribution of each function in earning that profit. That's what profit split says, that you allocate the system profit in the proportion of the non-routine contributions made by each of the parties to the related parties to the deal. So there are four non-routine functions that were contributing to the profit on the deal, and each of those 4 non-routine functions need to get a share of the profit. Each bank is unique because each bank will structure each of these 4 functions differently. In each bank, the importance of each of these 4 functions will be different. In some banks, sales, origination will be a very, very important function, and the way they will be driving that function will be very important. So no 2 banks will have the same revenue or profit split for these functions, because the contribution of each of these 4 functions in each bank will be different. And I'll give you an example of that. A Citibank or a JP Morgan, which is also a commercial bank, one of its most important functions will be, because they are very, very people, they will get deals where a lot of capital has to be put at stake. So if I want a huge amount of capital that the bank should put at stake, and I want the bank also to be participate in the deal, and I want a big, hefty bank backing my IPO, then I'll go to a large bank. Whereas if I am looking to find, so there what they bring to the table is their network, their capital. So capital becomes very important in their bank. Whereas if I go to a smaller bank for a deal, I'm an entrepreneur who wants to do an IPO or a debt fund, I'll go to a smaller bank if I know that this bank has the best set of relationships among institutional investors who want to invest in my industry. So if I ask them to structure my deal and do investment banking for me, they will get me access to the best institutional investors who invest in the energy space. And that will be the best success I can have, because they have the relationships, they know the people who want to invest in energy, and I want to get funds for the energy industry. So then what they will bring to the table is their relationships. Capital will be less important there because they will not be putting any capital in this. They will be bringing their industry relationships, their industry know-how, and the structure of the deal that they will be using to do that. So each bank will develop a different profit split or revenue split model by recognizing the contribution that each of these four functions are making to the deal. And they will mostly implement this globally in a consistent way. And then if India is doing one of the four functions on a deal which is happening outside, then India will get that share of the fee from the related party who is billing the client. That's how it will happen. And India then has to demonstrate that I got a fair share of the global deal for the contribution I have made, which is not routine, but my share of the contribution is this much only for these reasons in the context of how my bank operates. You will not be able to demonstrate this with third-party data. You may not get third-party data. And one of the challenges in profit split was that we are four related parties. We decide how to split the profit, but we don't have a third-party data. Why should the tax officer be convinced that you may decide how to split amongst yourself? And one of the challenges of the profit split method is, if you read the method, it says that you have to show a third-party comparable who would split the profit this way, which is impossible to find. So this issue went to the tribunal, not in the context of the financial services industry, it went into the tribunal in the context of the telecom industry, where the argument which was made by the taxpayer there was that if you apply this requirement to the profit split method, it will fail because third parties may never come together like this. So I can demonstrate to you why, based on objective reasons, I have split the profit this way. And I can show you the contribution. And even then the profit should work. And interestingly, the tribunal said yes, that if you can demonstrate that you've split the profit in the way that you have split objectively, having regard to the non-routine contributions, then just because you can't find third-party data to demonstrate that doesn't mean the profit split will fail. Very, very critical ruling outcome coming in the tribunal. And this is how even OECD says profit split should be applied. Because in all cases, in all industries, you won't find third-party comparables. Sometimes it's virtually impossible. So the point, again, I was making is that financial services, if of all the industries in transfer pricing, is the most unique industry because the business models are very unique. The drivers of profitability are very unique. The factors of production are very unique, and sometimes you will find unconventional answers, which then you will have to find how they fit into the right method. The example I gave you of the profit split. Okay, thank you so much for being such an attentive audience. Appreciate it.